what's the value of a stock that never returns capital to its shareholders? I don't know, because the only way you can make money is if somebody else is willing to buy that position at a higher price for some emotional reason perhaps, or for some foresight that maybe the company will return capital one day. And I think of when you learn as an investor over multiple decades is the only thing that matters is free cash flow.
Welcome everybody, it's your boy The Fat Stacks. Welcome to another Financial Corner. Today we are going to be talking about dividends and dividend investing and compounding interest. So I know there's a lot of videos there out on YouTube that talks about dividends and compound investing and what it means for long-term investing. But before we get into that, do your boy a favor, hit that like button, hit the subscribe button, and hit that bell so that you can get the notifications whenever I upload new videos. So as you can see the clip beforehand, you had Mr. Wonderful talk about what he thinks about dividend investing. And to me, it's very important because a lot of people don't know that in the long term, you have a lot of millionaires that the reason why a lot of them are still making a lot of their money is because of the investments that they make. And one of the big investments that a lot of people make that have a lot of money and have a lot of investments is they invest in the stock market and they invest in companies that have dividends. And I have my notes here, so I'm not going to be reading off my memory. Like I said, a lot of this stuff you guys can Google, look up yourself, look on YouTube. I do a lot of research myself, so I'm just passing on from what I've seen. So what are dividends? Dividend is a distribution of some company's earnings to its shareholders. So in common shareholders of dividend paying companies are typically eligible as long as they own the stock before the ex-dividend date. So as long as you own the stock and the stock pays out a dividend, you'll get paid. But it is important to know that when it comes to a company, it is important that you look at a company's balance sheet and their record. You have companies that are dividend aristocrats and dividend kings. So if you want to know what those companies are, you guys can look them up. As you see on my TD Ameritrade chart here, as you guys can see that I have invested in a few companies myself, and two of them on here are dividend aristocrats. One of them is AbbVie and the other one is Coca-Cola, KO. So ABBV and KO are those dividend aristocrats. So my investing strategy, as you guys can see on the laptop here, I mainly invest in dividend companies because I want a return over long periods of time with compounding interest. So now when it comes to compounding interest, dividend investing, if done properly, can share many of the same benefits that compound interest offers in certain investments. When you reinvest dividends back into the market, purchasing more shares with dividends earned, over time the wealth exponentially increases. Over the long term, you will earn more if you were to just take a dividend income and put it in your pockets. Meaning, whenever you get dividends, it's better to reinvest it back into your investment so you make more. For example, if you were to invest $10,000 in a dividend stock that had an average annual return of 12% and you reinvested the dividends in 30 years, that investment would result in $299,599.22. However, if you invested $10,000 in a non-dividend paying stock with the same annual return over the same amount of time, your total return would only be $132,676. That's a substantial difference of around $166,923 difference. Meaning you will get more over time if you keep reinvesting instead of just pocketing the money. Pretty plain and simple. But definitely what you need to understand is when I said earlier about investing in company, not investing in every company that has a dividend is a good thing because dividends aren't guaranteed. So the best way to check for if a company can sustain its dividend is by checking its balance sheet, being able to read the charts, meaning checking their cash flows, checking their debts, and all of this you can find online. The majority of companies business numbers and their track records, you can literally find them online, and all this information is free, literally free. So in order for a company to sustain its like I said, dividends aren't guaranteed. Sometimes some companies have to cut their dividend over time. So make sure that when you look at the history of the company, some of these companies have projections, check their growth. Free cash flow is definitely important, as you heard in earlier in before this conversation started. You heard from Kevin O'Leary, like I said before, and it's not just him. You also have Warren Buffett, because if you look at Warren Buffett's investment portfolio, you notice a lot of his companies pay dividends. If you look at Ray Dalio, you have a lot of millionaires, billionaires out there. Look at their investments. A lot of them are dividend investments. This is how a lot of them stay getting, stay not only getting consistent returns, but hefty returns over long periods of time. And this is why when you should start early when it comes to investing. It doesn't take a lot of money. It just takes consistency, little bit every month, little by little. Anybody can do it. You don't have to be rich. As long as you can, like I said before, read a balance sheet, you can understand, as long as you can read and understand the balance sheet, you'll be fine. There's plenty of information online that can teach you about dividend investing. And of course, you have your own personal strategy in how you want to invest. No two people are the same. So me personally, I look to invest in heavily in dividend paying stocks. And when I have enough money, then I'll try to look at, some companies here and there when it comes to growth, because I've done other videos that show that some of these companies, IPOs that just came out, a lot of times I've gotten on the low end, got in on the low end, and now some of them have skyrocketed. There's a lot of people that's in the market that are getting more and more into the market. Just having your money in a savings account is not going to help you. Yes, you want to have some savings for emergencies, but take your money, put it in investments, and try to build you and your family wealth. Now, you know, also, it also helps you when you have people that are like-minded that can help guide you. You can pay financial advisors to do these to find to help you with your long term, or you can do it yourself. Either or, it's up to you. But as you guys see here on my charts, when it comes to my dividend investing, now I'm gonna tell you right now, the dividend yield, when it's, as you can see on the top right, I want to increase my annual income off my dividends. That is my goal. And as of right now, there are a lot of companies right now that I have that are energy. Like, I'm trying to diversify my portfolio because the world is changing. Technology is changing the world. So what used to be, 10 years ago, it probably will not be 10 years going forward, because of how, with everything going on with the pandemic, has business changing their models and adapting to a different model when it comes to their businesses. So me personally, a lot of these plays I've gotten into early. I've even actually sold some stocks to get into the stocks that I really wanted. So when it comes to the dividend yield, you definitely might not want to be getting into companies that are like 10% or 8%. Like I said, some of these plays I'm only making for about 5 years before I take those investments and invest in another company. So that's just me, what I'm personally doing. But companies like AT&T, I'll be keeping long term. Chevron, I'll be keeping long term. AbbVie, Verizon, Coca-Cola, Merrick, AstraZeneca. Um, and every year I'm going to be checking their balance sheets and make adjustments. So, because this is something that I will be doing for long term. So I am looking to make sure that my investments stay consistent and that when I get to that retirement age, I can be comfortable and live relaxing because, you always want to do a lot of the hard work when you're young. You want to make sure as you get older, you want the money to work for you. You know what I mean? So I appreciate everybody that's here today. I will be leaving a clip for y'all to watch. So at the end, but make sure you guys, like I said, hit that like, hit that subscribe. Appreciate you guys being here. I just wanted to put out a little dividend video and show you guys the stocks that I'm in right now. That the majority of them are dividend stocks, what the yield is. But you definitely want to make sure that you check. Just because a stock has a high yield does not mean it is a good stock. I'm gonna tell you that right now. So you have to make sure that you look at the companies, look at what these other investors, millionaires, look at what their portfolios are, and shoot, you can mimic them. A lot of those companies are solid companies that have proven themselves over 20 plus years. And a number of them have had given dividend. Like I said, you have dividend aristocrats, kings that have been giving out dividends for so many years, and they've consistently done it on growth. So make sure you guys do your homework and just don't listen to just anybody on YouTube. Just make sure you do your homework. Like I said, appreciate everybody chilling with your boy, checking out this video. Y'all have a good day. Y'all stay safe. Thank you.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.